What's up, everybody? Stocks on the rocks. Got to have a little drinking music. What is going on, everybody? It is Thursday. Weekend's almost here. And it is our Stocks on the Rocks Thursday. We do these every other Thursday. So it's great to see you guys here. I see new names every week, which is fantastic. It's awesome to have you guys here. I got a few people coming in for the waiting room, so give them a chance here. If anybody feels, let's see, I'll make sure. So as I'm letting folks in the waiting room and they're coming in, one thing that I'll just kind of do housekeeping wise is that we let anyone and everyone come in and join us every other Thursday for our office hours / happy hour. Now, what that could do potentially is that could open up the door for someone who doesn't have very good manners coming in and, you know, kind of turning their video on or turning their mic on and saying things that aren't nice, not productive, rude and crude. Had that happen before. Please don't do that. That'd be awesome. That's all I have to say about that. And this is a session where, yeah, we open it up to everybody, right? We have a lot of members at TradersArmy who trade with us in our trading rooms each day. We have folks who are just on-demand members that watch our on-demand content and don't participate live. Maybe they're not ready to yet, and that's fine. And then this is just available for everyone. We like to, you know, hang out every other Thursday afternoon, have a little cocktail if you want, talk trading. And these sessions are designed to be driven by your questions and your curiosities, meaning I don't come planned with anything to talk about. I'm sure there'll be plenty to talk about, but I don't come planned with anything. This is not one of our regular trading rooms where we come with, let's look at these trades, this stock, this option position, this future position, let's trade it, things like that. This is just an open office hours, open questions, open answers, transparent. Let's have some fun. Let's all have an awesome afternoon. This session is designed to last as long as an hour. Usually it lasts an hour, sometimes a little bit longer. Try not to go too much over the hour because it is 8 p.m. on the East Coast right now. It's 5 o'clock where I'm at. I'm in California, so it'll be dinner time past that. So I try not to go too far past the hour, but sometimes we do, especially if we're on a hot topic and we need to, you know, keep it rolling. Not just going to cut it off because it's, you know, 9 p.m. Sava, what's up? What's up? Lee says red wine in honor of a red day. That is probably that's a good one. I've got my old trusty Espolon Blanco tequila, rocks, no lime. No, nothing. It's good old-fashioned tequila. Roy, what's up, buddy? How you doing, man? Good to see you here. It's been a little while, huh? But with that being said, I'm going to just kind of open the floor for questions. And so I will say, if you have a question, throw it in the chat box. If you want to, if you're like, man, this is just too long of a question, let's just talk. You can turn your microphone on. But like I said, just, you know, if you're turning your microphone on because you have intent to be lewd and crude, then don't turn your microphone on. I'll kick you out of the room. But let's have some fun here. Let's banter. Tech says, what are you going to do about a firm? That's a great question. A firm had a day today, didn't it? Everything had a day today. Everything had a day today. So a firm is a position that we have already rolled. So this is an option position. It's just for those of you guys, let me try that again. For those of you guys who don't know what this position is, we sell options in one of our trading rooms for passive income. We sell options, we sell puts, we sell premium. And we sell premium with the intent that we think price is going to stay at or above the strike price that we sell. And so we sold the 55 strike puts. I don't remember the date, but I'm betting it's somewhere around 25, 25, 26, expecting that Feb 25, 26, expecting that this level was going to hold. and the prices were going to stay kind of above all of this. And on the 28th, it looked good, but then every day since, the market's just been hammering down, and a lot of stocks with it, naturally speaking. So we're going through some short-term, um, painful moments here now, having to work for our money because positions that go below 55, that's this orange line, that was the strike price, the put that we sold. If prices go below 55 and I don't want to own the shares, I have to buy back those puts and I'll buy them back for a loss. Well, I rolled them down to 52. So we got a lower break-even price now, rolled for a net credit. So as long as the stock gets and trades back above 52 at expiration, then we get back all the premium we originally collected for the 55s, plus the losses on the 55s that we had to close to roll to the 52s. And as of yesterday, prices were not that far away. I thought we were, had a pretty good chance of getting above 52. But of course, I know it's Liberation Day, and the tariffs are out. And while the market loves transparency, I still think we lack some transparency, and there's more fear being instilled in the market, just in general. Some of that I think is probably on purpose. Um, but here we are. We are short the 52 puts, and the stock is at 39. So am I interested in taking the shares at 52? No, I am not necessarily. If I get assigned early, I'll likely roll back into some puts. And so right now, if we were to buy back, let me go up here. And I'll set this trade up tomorrow, so I'll roll it tomorrow. This expires tomorrow. I got 3 contracts at 52. I traded those for $5 on the roll, 501. So tomorrow I would have to buy those back for so widespread. Let's just assume somewhere in the middle around 13, right? 13. So pretty deep in the money right now. And so if I had to buy those back for $13, then that's, call it $13 or 1,300. Let's try that again. 1,300 a piece per contract times 3 contracts. So I got $3,900 that's going to go out tomorrow. Okay. To buy back these options in order to not get assigned and not have to take assignment over the weekend. So keep that number in mind, 3,900. Move this out of the way. So then I would go out, and I know that earnings are coming up, but not until about May 8th? So if we don't want to hold through earnings, I've got to consider more like these May 2nds. So I would roll out to the May 2nd. And I would look for the ability to roll these options down right now. To stay at 52, I'd be collecting about the same 1,300. So one thing would be you could roll out and just stay at 52, which I might end up doing. I'd like to roll down to maybe 48, 49, somewhere around this area, because we were just there yesterday. I think if we get a snapback move in the market, we could be above 49 pretty quickly. But the 49s are only bringing in about $11, right? So if I take 3,900 and I divide that by the 1,100 that I'm going to bring in, I've got to sell 3.5 contracts in order to bring in all 3,900. So what would I have to do? You can't trade half contracts. I need to bump it up to 4 contracts, which I'm fine with. I'm fine increasing contract size as long as I can roll down in strikes. And so to be able to roll down, and I'm only rolling up by 1 more contract, if I could roll these from 52 down to 49, yes, I'm adding a bit more time, like 30 more days, but giving it more time does 2 things. Obviously, it gives it more time to get back above 49. But also what it does is it will likely, because we're now 30 days out, I think is what it said roughly, it will smooth out our gamma and our delta exposure. So by rolling down, I roll from a 1 delta, which it wouldn't surprise me to get assigned on these tomorrow, or tonight, have to buy and own them tomorrow. But I'm at a 1 delta, which means dollar for dollar, I'm making or losing when I'm in these 52s. for tomorrow's expiration. Rolling out to May 2nd, 49s, I get less delta. So I've got more contracts, but less delta per contract. So while I'm increasing the required dollar amount I need to sell 4 contracts versus 3, I have less delta per contract. So instead of having what I have 300 deltas now, I'd have 76 delta times 4. I'd have 300. I have the same delta position. I have the same delta risk, but I'm able to roll out in time and down by 3 more strike prices. If I had to roll right now, that's probably what I would do. Tex. It's probably what I would do. Because I'm more interested, like when I'm rolling these options that are in the money and they got deeper in the money, like this is a rescue mission now, right? This is a rescue mission. And so sometimes in order to, and by the way, had I had stayed at 55, there's nothing wrong with that. You'd be collecting a bunch of premium at 55, but I am risking early assignment when that option is this deep in the money. I am risking dollar for dollar delta, which is why I want to roll down every chance I get, even if I have to roll out, which is almost always. Will maintain a higher notional value risk, but a lower or similar delta. And more importantly, if I'm able to roll down to 49 tomorrow, and that's what I end up doing, how much does the stock have to rally now for me to get out of this in the money position? Well, if I stayed at 55, price would have to rally 42% to allow me out above my original short strike. If I roll down to 49, price only has to rally 26 now. So the faster, the sooner, the more efficiently you can roll down strikes, even if you have to roll out in time. The market doesn't have to recover by the original amount. It has to recover by less of an amount, which is why I like the roll and recover strategy, especially rolling down. That's the ultimate goal, is to be able to roll down every time. Sometimes you're able to roll down pretty easily without having to increase size or too much notional risk. Sometimes you have to increase size, which increases notional risk, but rolling down gets you similar delta in the current position that I'm in. Does that make sense, Tex? About anybody? Does that make sense, everybody? So I rolled my 52s to 417. Oh, yeah, so you still have a little time. Yeah, mine expire tomorrow. I rolled mine, was it on the 21st? So I rolled mine here. So when the stock price, let me zoom in on that. So when the stock price was here on expiration, this is when I rolled it. I was in the money by $5, $6 actually, which made it fairly easy to roll down to 52. And then boy, did it pop up the next day. It was great. And then everything fell apart in the whole market. And this is what happened. Yesterday, I was pretty much thinking if we have a decent day, even if we get up to 50, it will be much easier when the stock is at 50 to roll down to 49. Now that the stock is at 39, I'll still be able to roll down to 49, but I got to increase size by a contract, which I'm happy to do. It's kind of a option version of dollar cost averaging, but you have, by dollar cost averaging, meaning if you buy 100 shares at 60 and you buy 100 more shares at 50, you have an average cost of 55. On stock, you have dollar for dollar delta always. And by averaging down, you double your delta when you're buying twice as many shares to try to average down. Here in options, I'm not trying to double my delta. I'm trying to maintain a similar delta position as the original trade. I'm just trying to roll down in strikes. Even if I have to increase size, I'm trying to stay roughly within similar delta, not getting myself too overweight in delta, if that makes sense. Santosh, what's up? Has a question. Hey, Corey, what's up? What factors do we need to consider to buy leaps? Well, certainly longer term. So a leap is defined as an option that that has an expiration 9 months or more. Oh, thanks, Tex. Really good advice. I appreciate that. I try, man. Try to be, try to give good, not advice. I'm not an advisor. Not an advice. Not an advisor. But I try to give good tactic, right? And we're always learning too. So like, there's, I've over the years I found good tactics, and then I found, oh, if we do this, this is a better tactic. And you guys always get, as soon as I find a better tactic for anything, you guys are always going to get it first, right? We've talked about this a bunch in our trading rooms. I've introduced things to you guys that we've built and we found out that are really great tactics, and I introduce it right away in the trading rooms. This is great. We should start doing more of this, right? So appreciate that. That's the goal, right? Um, so when buying a leap, you're buying an option that has at least 9 months until expiration. So I think the most important consideration is, what is your 9 month or longer outlook, right? If your 9 month or longer outlook is bullish or bearish, then you can lean more towards calls or puts, right? From a mechanic standpoint in options, let's just I don't know. We could use this stock, I guess, while we're on it, right? Let me hide these positions because I'm going to build a couple positions in here. So from a mechanic standpoint, we're talking option Greeks. Okay. It's not an uncommon kind of guideline if you're buying an option, right, for speculation, to buy an option that at least has 100 days to expiry. I'm sorry, 90 days to expiration, 100 or more, just to get away from very rapid negative theta. And so if you were to buy, let's say you had a long-term, or unless you want to give me an example of a stock you're looking at, but if you had a long-term outlook that prices were going to go down or prices were going to go up from here, um, you can buy an at the money call, right? Let's just start with at the money or at the money put, right? And so what you'll notice on the call side is you're buying, call it a 57 delta. It's at the money, so it's going to be somewhere around 50, whether you buy a short-term option or a leap option. You have $3.35 a day per contract that you're going to lose due to theta alone, and you have $8 per point in volatility exposure. That's your Vega. Okay. Put option is going to have something similar because it's the same strike, same expiration. Now, if we were to go out and buy a leap, we're talking about something January and beyond, right? So let's say it's January that you're buying. Let's go to the same strike even, at the money, same strike call, same strike put. Now, I'm just going to compare the call options first. So 40 strike call for July, 40 strike call for January. So we're getting a 57 delta for the July calls, about a 64 delta, so a little bit more deltas for the 40 calls, which would indicate, by the way, a longer term, so out to January, the market is pricing in a greater probability that the stock is above 40 versus July above 40, right? Higher delta means higher probability of being in the money. Not a higher probability of making money, just a higher probability of being in the money at expiration. Two different things. Now, shorter term call, still 107 days away from expiration. $3.35 a day is what's going to cost you in theta. You go out longer term, and we know that theta is less impactful on our long call position further out in time. So that's a good thing. So a long-term option has less exposure to theta because you have a long time and you expect a longer term outlook. You don't want to lose the same $3 or $4 a day in theta. Now that will ramp up over time. So if you're in this position today and you're all the way out into August, your theta is going to start to ramp up. You get into September, your theta is going to get bigger, right? But because now you're closer to expiration, your theta has to speed up. So let me go back to today's date. The one thing to consider, probably the biggest thing to consider outside of long-term outlook, bullish or bearish, would be, where's volatility today and what do you expect volatility to do in the future? And that's the thing about long-term options. So Vega, your volatility exposure on a 90 or 100-day option, in this option is $8 per point. Long-term volatility exposure is greater, so you have greater vega out in time. So you'll have greater volatility sensitivity in the future, but less theta sensitivity going far out. Okay. I mean, really, the biggest one is directional outlook. Premium, you're going to pay more, right? So risk reward is going to be still an important consideration. All the same considerations still exist from buying short-term options versus long-term options, except it is important to at least note that a long-term option versus a short-term option has less exposure to theta, but more exposure to vega. And so if volatility happens to be really high, which in this stock it is, if volatility drops back down to 73% from where we're at now, 100% in volatility, if this stock drops 30 points in volatility, you'll be less impacted on a shorter term option, more impacted on a longer term option. So I would say the biggest advantage of knowing that volatility is low, or at least somewhat low, you'd have a better advantage, from a volatility perspective, buying a leap option over a shorter term option if you're playing price movement and volatility movement. Other thing to consider that I just thought of is spread width, which is tied to open interest, right? So these options out in January seem to have decent open interest. Spreads are anywhere 15 cents wide on the puts, 40 cents wide on the call, and it's after hours. So obviously that'll be different when the market opens. But shorter term options, go to July. Oh, these are worse. These are terrible spreads. So just look at spreads, look at open interest, make sure, because sometimes the leap options don't have as much attention. January usually does, because there's January options on pretty much everything. If you were to go out and buy March leaps, they still have more open interest in March than they do in July, which is shocking. So open interest and spread width would be an important one to consider as well. But these are all things that we look at for short-term options and leap options. So a short-term option versus a leap option, all the same things you're going to look at and consider before entering. Except I would want you to understand the difference between short-term theta versus long-term theta exposure, short-term vega versus long-term vega exposure. Those are the biggest things to just know the difference between a 90-day option and a 280-day option. Does that make sense, Santosh? Cool. Awesome. Sava says, sorry. So same strike calls with different expiration can have different delta. That is correct. And that is especially true for out of the money options, especially true. At the money options should technically always have right about a 50 delta, right? Why? Because regardless of how long to expiration you have, ooh, that zoom didn't work very well. Let's go here. So regardless of how long you have to expiration, an at the money option is 40, right? So I put a blue line where the 40s are. Thinking about delta from a odds of being in the money at expiration perspective. That's one of the things. So delta can be used to determine how much you make or lose if the stock goes up or down by $1. It can also be used to determine the probability that option expires 1 penny or more in the money. So at expiration. So if the stock is at 40 now, let's just say it was at 40 exactly, even though it's not. What are the odds the price is above 40 versus below 40 if the stock were at 40 right now? What are the odds? Regardless of time to expiration, 1 week from now or 1 year from now, what are the odds the stock is above 40 or below 40 if the stock is at 40 now? We're looking for a percentage, odds. And I'm watching the chat box and I see crickets. There it is, Carl, 50-50. There it is. That's right, Jason. 50% chance it's above 40, 50% chance it's below 40. So That being the case, all volatility, all demand for calls and puts being equal, an at the money option always, always, always should have, theoretically, a delta of 50 or right around 50, right? Representing a 50-50 chance of being in the money versus out of the money. Now, in the event that the $40 calls are pricing in a higher probability, right? So let's say right now the January calls have a 64 delta, and they're out of the money by $2, $1.10. So if those are priced at a 64 delta on the calls, that means the puts have a 36 delta on the puts, right? 64 and 36 is 100, right? Yeah. So January, the demand for call options is greater than the demand for put options out in January. So if the demand for call options is higher than the demand for put options at the same strike, then that means that the market is going to price in premium and delta a greater probability the stock is above 40 because there's greater demand for those, greater volatility exposure. Does that make sense? Yep, a delta of 40 is 40%. A delta of 64 is 64%. Percent chance that that option is in the money at expiration. Again, very different than the odds of you making money. Because if you spend $10 on a $40 option and the stock is at 40.01 at expiration, it's worth a penny. You lost $9.99. Still lost money, even though the option's in the money, right? So delta just simply represents the probability of that stock expiring in the money. Now, let's take that further and go out of the money for a second, just while we're on the subject. So let's go with a 8-day option here, just for extreme purposes. Have a look at, let's see, have a look at an option that is out of the money. Let's say at the 42 strike, it has a 32 delta. On the put side, the 3650s have about a 32 delta as well. So equal distance delta-wise out of the money, right? 32 delta, 32 delta. And we're at the 42 strike on the calls and the 3650 strike on the puts. And there's about a 32 delta for each. But those expire in 8 days, which means 8 days from now, there's only a 32% chance those options expire in the money because they're out of the money. Now, before I even switch to a January set of strikes, we're going to look at the 42 January calls and the 36, 50, or even 36. I don't know if they'll have 50-cent strike increments out there in January. So probably better just to choose the 36s, right? 36. Because we're probably going to have $1 strike increments out there. So around 30 deltas. If we were to go out to January, what do you think the delta is going to look like on those same strike prices out of the money, given a more than 200, actually exactly 280 days more time for January to make a move versus the stock to make a move by April 11th? What do you think the options are going to look like delta-wise? Will they be greater deltas at the same strikes or smaller deltas at the same strikes? What do you think? When I go out to January, I want to know, will the 36 have a higher or lower delta on the put side? And if I look at the 42s, will it have a higher or lower delta on the put side? Keeping that thought in mind that delta is equal to the probability that that strike expires in the money at expiration by 1 penny or more. You think the delta on January is going to be higher or lower? Watching the chat box. All right, got one answer in. Carl says greater. Delta will be higher. Okay. It's looking for more. Roy says higher. Okay. Anybody else? No? All right. You guys are both right. You're spot on. It will be higher. Why? Why will it be higher? Because given 280 days more time to do it, the odds of the stock being above 42 or below 36 has to have a greater probability because it has 280 more days to be able to accomplish it. So let's go out and look. January. We don't even have a 36 delta. I mean, a 36 strike. Oh, man. Well, what were we at? 40? We don't even have the same strikes. Okay. Very different strikes out here. All right, so let's look. 50, strike, out of the money. 30, these are so skewed right now. These are so skewed towards the calls. If I'm a betting man, this stock is going way higher over the next 9 months because that's what the options are pricing. Well, this isn't a great example because there's a huge volatility skew. September? No. Man, these option deltas on the put side are very low. So low probability the stock is going to drop, high probability the stock is going to rise. Well, what about SPY? Just kind of see the point here, you know what I mean? Might be a skew on the put side. No, there's still a skew on the call side. Look at that. A little bit, not much. Okay, so let's go, what are we, 536, 535? Let's go out to the 575s, 29 delta. And let's go out to the 505s, 28 delta. So 505, 575. Right around 20, right around 30 delta. 575, 505. January. 575, 505. The delta on the puts is about the same. It's a little bit higher, but the delta on the calls is 12 points higher. Again, pricing in a more likely move to the upside versus downside. But given enough time, there is a greater probability the stock is higher or lower than it is today. Therefore, the further out of the money options don't decrease. SPY. They don't decrease quite as dramatically. You take an 8-day option, 575s. They have a 2 delta. Why is it only a 2 delta? Where'd it go? Why is it only a 2.6 delta? Well, because the odds of the S&P being above 575 in the next 8 days is a whole lot less likely than the S&P being above 575 over 100 days, and even less likely than over 288 days. So as expiration approaches, the out-of-the-money options will drastically shrink in delta, but the longer-term options will have a much smoother delta profile, much more delta on out-of-the-money options. But still, at the money, they should always be right around 50 anyway, unless there's a vol skew. Long-winded, but did that make sense? I'm not known for my short-winded answers, by the way. What's up, Daddy? Corey, what would you do if your put option got assigned and you would like to roll to another put option by selling the shares? What should you determine if you want to lower your strike? Should you increase the deltas or longer expiration date? Great Great question. So let's take an example. Let's take let's take a firm, right? Why not? Or do you have a stock you want to take a look at? Because I might be assigned on a firm tomorrow. Do you have a stock in particular you're talking about, Danny? Let's not make this hypothetical. Let's make this real life. If you don't, I can make something up, but no, not yet anyway. All right, so let's take this for an example. This Affirm, because this is one that I'm in, and I might get assigned in the morning. Now, if I get assigned, then I'm an owner at $52. Or Google, you want to use your example, or you want to use mine? If you want to use your example, I'm going to need some fast answers. Right? Mine? Okay. Yeah, so same concept applies here. So let's say, so I'm short the 52 puts in a firm, and let's say I get assigned tonight, and I own 300 shares tomorrow. In your download, don't forget, for the Wealth Essentials model portfolio, you have a roll shares back into short puts here. You have that, right? So let's say I'm going to use a firm, and my position size will be 300 shares, and my cost basis is $52, and the current price of the stock is at, what did I say, $38.91? Yep. I am down $3,900 in this position if I were to sell it today. 3,900. Now, if I go out to April, what did I say, 2nd, we're talking about rolling out to tomorrow if we don't get assigned. Not April 2nd, May 2nd. Sorry, May 2nd. $517. I love this spreadsheet for this reason. We need to make sure we're collecting $3,900 in premium to offset the loss that we have on these shares. Okay. And this is just our loss on the shares. So whatever you collected in premium to sell those puts, that's yours to keep. So we're not really down $3,900, but I want to roll for a credit every time and not consider that original premium against my cost basis, but I guess you could. So if you were considering your premium intake, then your cost basis might be 51.20, right? If you got an 80-cent credit, your cost basis is 51.20. But I always consider my assignment price. This gets me credits along the way. So let's say I want to try to roll down to 49. First of all, you got to pick your strike. Where do I want to roll down to? And earlier I said if I could roll down to 49 from 52, then that would put me right around here, which is where we just were yesterday. We got as high as 48.75. So if you wanted to run an example of what kind of roll down to 50, kind of roll down to 49, kind of roll down to 47, kind of like where can I roll down? So let's start at 50 actually, right? Let's start at 50. And I'm going to stay with May 2nd because that's before earnings. Okay. So the 50s are bringing in, let's call it $11. Right, spread's kind of wide, hard to tell right now. It's bringing in $11. So the premium would be $11. And if I stay with the same 3 contracts, this is what you're asking here, right? Then 50 strike, 3 contracts. I'm lowering the risk by $600. That's the notional value risk, but it's going to cost me $627. And I don't want that to be a cost or a net debit. I need this to be a net credit. So I would adjust this up 1 contract. 4 contracts gets me a net credit, but I've increased the risk, the notional risk, meaning if the stock goes to 0, from 15,600 up to 20,000. So I've increased the risk, the notional risk, up by 28%, which is acceptable for me, generally speaking. That's fine. because I'm getting down in strikes, right? If you wanted to say, well, what would I have to do to get down to 49? Well, 49s are paying about, let's say $10.60, $10.70, right? So I just copy that whole row, move it down. 49 is the strike, $10.70. And now I'm still getting a credit, but not much of a credit. Okay. Well, does that mean that I can roll down? If I'm going to go up 4 contracts, I might as well go up as far as down as far as possible. Can I get to 48 and get, call it $10 in premium? I can actually. I can go down to 48, bump up by 1 contract, not much, right? And still roll for a net credit. And I'm getting down to 48. It's when I start to get into this, okay, what about 47? $9 credit. That's why you need to use this calculator. It's much easier. 47, $9 credit. Now on 4 contracts, I'm not getting a credit. So what I have to do, I have to jump up by 5. Now I'm getting a credit. But now you have to be, am I okay? All right, PBJ, good to see you. I'll see you next time, my man. I just assume you were a man. Sorry. PBJ, nice to see you. I'll see you next time. You're getting a 573 credit, but you had to jump up another 8 grand in risk. So now you're increasing your notional risk to $50, 50 by 50% from 13,000 to 23,000, almost 24,000. So this is the point where you got to say, ooh, how much am I willing to increase my notional value risk, which is the money that you have to put up in a cash secured environment to maintain this position. Okay, so that's one consideration. One column I don't have here, which I actually would probably like to see it in this spreadsheet, because you asked the question and I was thinking about it earlier as well, is, well, I'm in 3 contracts now. I mean, if I say, I mean, sorry, if I go, I'm in 3 contracts, so basically that means I have 300 deltas on the stock. What's the delta? Contract delta, position delta. I'll make this look pretty, but I think this would be important, right? So by going to the 50s, the delta is about 87. 87 delta. By going to the 40, what do we say, 49s, we got 77, 75, 74. 77, 75, 74. So then if I go equals this times position size, this would help you determine how much extra delta you're adding to your portfolio. It's a good thing to look at, right? So I'm going to keep it in here. I'll just make it look a little pretty. So if you want to stick with the same delta, the answer is roll down to the 48s, do 4 contracts. You get a little bit of a credit, not much, but you get a little bit of a credit, and you're sticking with the same delta risk. Higher notional value risk, but you're only increasing your notional risk by 23%. That's a good number. Even if you were okay increasing delta by 8 delta points to get a bigger credit, that's not bad either. I think where it starts to get, well, do I really want to increase my delta that much more? Depends upon, how much, what's your comfort level for adding 70 more deltas, because you're adding 2 more contracts, not from your 3, but you're down to 47. So it's a balance, Deddy. There's not a black and white answer. It's a balance with respect to, okay, I'm willing to increase delta if it means I can get above my short strike sooner. And for me, being in like rescue mode, if the stock has to be above 47, that's a much greater chance of the stock being above 49, much greater chance in the stock being above 52 or even 55. So would I want to see my delta double? No. Would I want to see my notional value double? No. So you could say all you want, well, I want to get down and get these down to 36. I want to roll my 52s down to 36. And I would say, good luck. Now you could do it, but look, you're only getting 220, maybe 230, 225, something like that. Let's see what the spreads are. You probably get 240 for those. Generous 240. And now you're at the what 30, what did I say, 35, 230, 36. So now they're back out of the money. But notice you got to go up to 17 contracts to get any credit. And your delta went from 300 to over 1200. So you quadrupled your delta and you got 292% higher notional value risk. So great. I'd love to get down to 36, but I'm not willing to take $15,000 notional risk and bump it up by another almost 50,000 just to get down to 36. So that's just me. I wouldn't be comfortable doing that. That's going to add an enormous amount of risk, delta risk and notional risk. I'd be comfortable around the 30, 40, 50% adding notional value, increasing delta a little bit, especially if I can get down to 49 or 48 or 47 in strikes. But that's how I always compare how far down can I roll without adding too much delta. Too much more, even though I might add a little more, but too much more delta. Does that make sense, Teddy? So that comes with your download. And even if you don't use the Wealth Essentials model portfolio to track your trades, use it for these calculators, the option roll calculator, the roll shares back into short puts calculator, the free roll calculator, right? I built these so you didn't have to do math on paper or try to figure it out. It's such a great way to see and contrast, because right away I would say, hell no, I'm not doing that. I'd do that. I mean, it increases notional value by 50%. That's not terrible. I get a good credit and I'm down at 47. So if I really desperately wanted to be down that low in strikes, I would go that far. That's fine. It's fine with me. But I'd also be fine at the 30, at the 48 or 49 level, just based upon, price action. 48, 49 would probably be fine. And you're not increasing your delta and you're not increasing your notional value by all that much. I think also the important thing with increasing notional value is I've had to roll stocks, and I'm in the middle of it right now, having to roll options multiple times, right? Because the market just keeps hammering down. So multiple rolls may need to happen sometimes, not often, but sometimes. And so I want to be mindful that, yeah, I want to roll down, but I don't want to, increase my notional value 100%, 200% every time I roll down, right? I want to leave a little notional value, a room in the notional value to increase little by little if I have to keep rolling down. So 50-ish%, I usually try to keep it around 50% increase in notional value or less. At least on the first roll. So if you wanted to keep it under 50%, then 48s might be a good option here. 47s are good. It increases it by 50%. This way, if I need to roll down again and increase by another 20% or 30% or 50%, I'm not doing it all at once, right? I'm incrementally rolling out and down. Is this Wealth Essentials model portfolio in the website download? Yeah, I believe it is. Let's triple check that. I would hate to say something that isn't true. So, let me go. That's the back end of the website. So give me 1 second here. What time is it? 10 minutes to the top of the hour. All right. Whatever your questions are, let's go ahead and get them in now. So pro member community lobby. No, my downloads. Yeah, there we are. My download. Where did I put this? It's been so long. Let me double check. So my downloads, option trading journal, wealth essentials, portfolio tracker. So download. Let's see. What do we got? Open up Excel. Oh, you know what? Looks like I need to update this. It is not. I've got option roll calculator, free roll, but I don't have the roll back into puts. I'm glad you asked me that. Must have been one that I added after the last download. So I will add that. You found it in the Wealth Centers model portfolio? Right, but the downloadable one, Mark, is the one he's asking about, the downloadable one. So I just downloaded it and it's not there. So I need to well, also, hang on a second. Oh, there it is. Yeah, sorry. This is the latest one, 2025, but I don't have the roll from long stock back into short puts. So I'll fix this, in other words, and I will and I'll re-upload it. It's probably pretty straightforward, right? Let's see if this does it. I just plagiarize what I see, as you should. How many rows do I have here? So let's see if I do that. Oh, I'm gonna have to fix that. Yeah, I'll have to fix it. I'll probably have to re-download, just download from Google Sheets, clear out all the data. So it'll take me a minute, but I'll get it uploaded. I just plagiarize whatever I see, as you should. As you should. All right. I'll get that fixed up. But was that helpful, Betty? Does that make sense? Fantastic. And you can see I already did this once with the firm. I was assigned on 200 shares at 55. When I closed the stock, it was at 48.31. And so I had to roll up one strike price. So I increased notional value by 41% there and got $165 net credit. And looks like I'm going to have to roll it again. All the buttons are in different places. Yeah, I mean, if there is anything in this world that I despise, which is not much, but it is all, yeah, all Microsoft products, every one of them. I, to me, and I don't, maybe just because I've never grew up on Microsoft, I grew up on Apple. Yeah, to me, they make things way harder than they need to. Google Sheets, man, that's what I do. So by the way, if you want a Google Sheets version of this, so just keep it in Google and not use Excel, I can send you a link to Google Sheets and you can make a copy and keep it in your own Google Drive. Roy, PC during the day, Mac at night. I couldn't do a PC. I bought a PC. I had to buy a Lenovo laptop to take with me while I was traveling, teaching on-site classes. And the academy that I was teaching for only used TradeStation as a platform, which is PC only. And I had to buy that PC just to be able to load TradeStation and teach off of it. Fast forward to a year ago, we went out to see my son. He was touring throughout Canada and the upper US. We flew out to go see him. My son, who plays, he's got both my whole family has Macs, but one of the games that he plays was on a PC, and so he was using that Lenovo. Took it with him on the way home. He left it at He didn't notice, but until we got home, he left it at TSA in I don't know what airport we were in. Toronto. Toronto. Yeah, he left it in Toronto. Um, and we called, and a month later, they found it and said, "We'll ship it to you. $180 to ship it to me." I'm like, first of all, it was only $700 to buy 9 years ago. I'll never use that computer. My kid might use it, but he's got his own gaming computers and his computers at home. I'm like, you can have it. I'm not doing that. You can have it. So no more PCs in our house, not one. If you're a techie or hands-on with computers, anyone can do this the right way if they know how to use the PC. Yeah, I know how to use it. I just don't prefer, working my way around one just because I've been on Mac for so long. I'm talking 32 years I've been on Apple computers. 32 years. Denny, great question. How about if you roll to a longer dated option instead of shorter to lower the strike by not increasing contract size? Very good strategy to go out in time more because you're going to get more extrinsic value. And you've got a smoother delta because you have smoother gamma. So think about that for a second. If the option is further away from expiration, you're not going to be able to close it out for 90% of profit as fast, but it's got a much smoother, longer delta, much smoother gamma. So you don't have a lot of gamma risk. You don't have a lot of, I mean, you still have delta risk, obviously, but you'll get more premium. So you shouldn't have to increase your position size by all that much. The only but to that whole statement, which I think is a great idea, and I'll do that when I need to, but there is a chance that you'll have to hold through an earnings announcement if you roll out to a too long dated option. So you got to be okay with that. That's the only thing, right? Rolling out past earnings and holding through could offer some additional volatility that you might not be a fan of. But that's the only thing. If that's the case, you could always roll it out to a spread, right? You could always now, if you roll it out to a spread, you are going to have to watch. You're going to have to increase the risk. So, for instance, the position size. Sava, that's almost as old as me. Well, I just turned 50 in December, so I'm not a young pup anymore. Yeah, I think I bought my first Mac. Well, the first Mac I bought was the very first time they switched from the old tan Apple computers, the tan with the deep monitors, to the blue kind of fluorescent see-through. That was the first one. That was back in mid 90s, mid 90s. That shit was expensive, like a $3,500 computer. And I'm like, oh my God, I'm a musician and I wait tables. I don't have that kind of money. But I did it and I've never looked back since. Okay, so let's take this one step further and say, what if I did a firm, oops, and I wanted to roll down to the 36s? Obviously, those were only paying, I mean, it's kind of extreme. I don't know if I'd do that, but 38s are out of the money. Let's go 38s. And you're getting 40 delta. And you're only getting about $3.30 in premium. Obviously, you would have to increase your size by quite a bit. 12 contracts, 13 if you want to get like a decent credit. But you're increasing your notional value and risk of the stock going to zero. Really, that's what it is. Up 216%. So it feels kind of like kind of a lot. So what you could do is you could go, and this is not a great example right this moment because the spreads are ridiculous. But go out and buy a really far out of the money option, right? So 38 by 25. Now, you're going to get a little less of a credit. Let's say it's 301. New line. 3.01. But notice, if you go to 14 contracts, your notional value in a spread only changes by 16%. If you do the spread. Why? Because you're limiting your risk to the difference between 35 and 25. So yeah, you'll have to go up a lot in contracts, which is really just more commission. But you don't have to go up a lot in notional risk to get a net credit and roll from 52 down to 38. That's a big roll. And so if you find that your notional value increase is just way out of control high for where you need to be or want to be, you could always consider rolling into a spread. Now, I will say this, and you probably know this, it's much more difficult to roll a spread. If you have to roll this again, it's a little more difficult to roll a spread without, again, dramatically increasing position size versus rolling a naked option. So if you're trying to control your risk or you're going to have to hold over earnings, then a spread may be the better option because at least it defines your risk and you're not having to increase your risk by all that much. See how that works, Daddy? Does that make sense? Sweet. Awesome. Awesome. Let's see. All right. Top of the hour. Roy, let's meet and discuss. Yeah, you want to meet and discuss some stuff, your future of trading and training over Zoom, the phone. You wanna hang out for a few minutes right now? You wanna hang out afterwards? Bedtime for you, Sava. Or if you want to schedule some time, do this, Roy, because yeah, I was just thinking it's about 6 o'clock here in my time. They're probably waiting for me there for dinner. But what I'd like to do is I'd like to maybe hop on either a phone call with you, Roy, if you have some questions about your future training, where you want to go, or let's just hop on Zoom at some point. So do you have my email address, Roy? No? Here. I'll give it to everyone. It's good for everyone, but Roy, why don't you just email me here? Corey Lane at TradersArmy.com. Grab that email address, Roy. Email me tonight, tomorrow, whenever you feel like you want to email me. And then just say, hey, how can we connect? When can we connect? And we'll set a date and we'll talk. And we'll see if we can't get all your questions answered and figure that part out. All right. Because right now you're just focusing on demand content. Is that right, Roy? I'll just double checking. Yeah. So, which is great. Build your on-demand muscles, build your content muscles. Now we need to get into the concept of trading, trading live, seeing live trading, being a part of live trading. And I think that the next step would be to bump your on-demand. Like the short answer would be bump your on-demand monthly up to a pro member monthly. And so that would be one of the things that we would definitely talk about, right? And so here's what I'm going to do. I'm going to do this for everybody right now. So I'm going to put a promo code, make sure it still works. Trader 60. Take that promo code down. That's for everybody who's not currently a member. Everybody who comes in as a member has already used that or some other code to get in as a discount. So if you're already a member, that one doesn't apply. But if you're not a pro member and you want to become a pro member or try it out, that discount code, I'm going to double check right now. You go under memberships and you want to go to the pro membership month to month, unless you want to go long term. I don't think that Trader 60 applies. But if you were to, I'm logged in, so hang on a second. Let me get to a different browser where I'm not logged in because I want to show you that. Any springtime offers? That's a good question. We should have done a Liberation Day offer. Boy, did I miss that one. With the stock market getting cut in half, so will our membership dues. How about that? I would actually probably do something like that. Actually, isn't a terrible idea. Portfolio cut off by 25%? Here's 25% off your next membership. Let's make it 50. Anyhow, so discount code Trader 60. Just want to make sure it works. Apply, and that'll take your first month down to $59. So $10 more than you're paying right now for your first month. And then after that, it's $149 a month. And if you decide you want to stick around, it is going to be a benefit for you to look out for some of our annual membership discounts. Because right now, if you were to sign up for the annual membership, I think it's $14.99 a month, which saves not a month, $14.99, which saves like $300 a year. But when we do our big sales, which will probably come like big ones, I don't know, I might pull one out for spring, but definitely around summer, like 4th of July. We always do something around there. We'll usually, again, discount month to month, give a little bit more than 1 month. And then we'll discount our annual even more. So we'll keep an eye out for that kind of stuff. But yeah, we're coming up on that period of time where we not need to, but we'll throw out some sort of offer. We do a couple times a year, we'll do some special offers. So we'll throw that out. So yeah, so check it out. And then yeah, if you want to talk further, Roy, about specific steps outside of how you should use the pro membership, things like that, then just catch up with me over email and then we'll hop on and we'll talk more over Zoom, or we'll hop on a phone call, something like that. I'm happy to do that. All right. Yeah, send me an email. And that Trader 60 promo code will get anybody who, again, is not a member, who's watching right now, will get you 60% off your first month's pro membership. It does not, I don't think it applies to on demand. I think that's pretty cheap already. I should probably raise that, but I won't. I like to keep things cheap for you guys. Even at 149, what is that? $4 a day in trading rooms? Is that $4 a day at 149 a month, something like that? So, I mean, I'm not quite sure how you can beat that. Average, call it 30 days in a month. Yeah, it's $5 a day. I'm not sure how you can beat that. I'm not sure I can lower that anymore, but we give, offers and things like that, little promo offers. So make it happen. Let's have some fun. Let's make some money. Let's learn a lot. And it is a little bit past the top of the hour. So appreciate you guys hanging out as always, taking some time out of your Thursday afternoon. I know you could be doing anything else but this, but hopefully when you show up to trading rooms and office hours, there's always something that you pick up and learn, and hopefully little aha moments here and there. And learning to trade is definitely a game of inches, and it's a journey. And every inch that you gain in the short term will long term offer exponential return on investment for your time here. So I certainly appreciate you guys spending some time with us. It's awesome. Because it would be weird if I were talking to nobody for an hour. So thanks for being here, guys. So let me know if you have any questions. Let me know. We have Herman in the futures trading room tomorrow morning. So with that being said, have a great weekend, and I will see you on Monday in the options trading room, or 2 Thursdays from now in the next Stocks on the Rocks. All right. Oh, you know what I need? I need some outro music is what I need. Some outro music.
Hi, y'all.